This video covers Roman numerals 3 and 4 from Chapter 3 about audit reports. Let's look here at Roman numeral 3 first. Here we have unqualified audit reports with emphasis of matter, explanatory paragraph, or some modified wording. There will be nothing wrong with the client from an accounting standpoint, but the auditor is just going to bring something else out in the audit report. So we'll see some circumstances starting on page 54. And what happens is the auditor can issue a clean report, but must modify some of the wording of the standard unqualified audit report. And generally, that's going to involve adding an explanatory paragraph after the opinion section, because the opinion section is not modified, so the reader does not need to read through this explanatory paragraph before looking at the opinion. And as always, again, the auditor will not change the report due to any of these conditions unless material. And the first condition I'd like to talk about is lack of consistency in applying GAAP. So it could be that the client has changed accounting principles. And we'll see a couple of specialized instances where it's not quite a change of accounting principle, but I'll take you through them. They're quite easy. So we see that the auditor is going to modify the report by adding an explanatory paragraph again after the opinion paragraph, only if consistency is affected. That would be an actual change of accounting principle. Not if comparability is affected. And I will show you those distinctions on pages 55 and 56, and I will show you an illustration of the report, again in our textbook. By the way, the client must also disclose lack of consistency in a footnote, so a change of accounting principle, otherwise disclosure is inadequate. And the auditor must also agree with the reason for the change, otherwise treat it as a departure from GAAP. For example, if the client changes from LIFO for inventory valuation to FIFO for inventory valuation, the auditor must be convinced that the actual physical inventory flow is roughly first in, first out. I'd like to go with you here to the book, and as I take a look, there, on page 55. So lack of consistent application of GAAP, we come to this section about consistency versus comparability. So we see that the auditor must be able to distinguish between changes that affect consistency, accounting principles that is. So there's a change of accounting principle, and those that may affect comparability but do not affect consistency. And the following are examples of changes that affect consistency and therefore requiring an explanatory paragraph if they're material. If they're not material, we don't worry about them. So first is a change of accounting principle. A simple one, such as a change from FIFO to LIFO for inventory valuations. I'm sorry, by the way, the client is going in that direction because LIFO is not in accordance with IFRS. LIFO was an American invention during the 1930s, during the Great Depression, and it was used some then, but it was really used in the 1970s and 1980s in times of high inflation, because the last inventory to come in had the highest cost, and then when you expensed it first as cost of goods sold, it gave you the highest possible expense and therefore the lowest possible income, at least for tax purposes. Now, the second is kind of a specialized change of accounting principle, I guess. Changes in reporting entities, such as the inclusion of an additional company in combined financial statements. I will leave it up to you to decide if that is a change of accounting principle or not. When you get to advanced financial accounting, you would take it if you're in the MAC program. But anyway, change of reporting entity, we must bring it out in the explanatory paragraphs at all. Now, number 3, corrections of errors involving principles by changing from an accounting principle that is not generally acceptable to one that is generally acceptable, including correction of the resulting error. So number 3 is non-GAAP to GAAP. Number 1 is GAAP to GAAP. We will hope the company does not change accounting principle from GAAP to non-GAAP. If they do, well, they're going to have to deal with some departure from GAAP in terms of a qualified audit opinion or, heaven forbid, an adverse opinion. Then we see some changes there that affect comparability but not consistency, and therefore need not be included in the audit report. The first one is a change in an estimate, such as a decrease in the life of an asset for depreciation purposes. If that happens, well, first of all, companies do it all the time, so we would be bringing out explanatory paragraphs all the time. Second thing is that if that happens, most people don't care. So most financial statement readers aren't going to care. Number two, same story. Error corrections, non-involving principles, such as previous year's mathematical error. Happens all the time, plus very few financial statement readers would ever care. Then, number three, variations in form and presentation of financial information. Cosmetic changes, that is. Again, very few readers care, plus companies do this all the time. Number four, changes because of substantially different transactions or events, such as new endeavors in research and development or the sale of a subsidiary. That's something new, so there has not been any change of accounting principle for an existing asset or an existing situation of something else. Right up above here in figure 3.5, we see an explanatory paragraph because of a change in accounting principle. So, independent auditor's report is always up top. In fact, everything in the very top part of the report is the same. We get down to the very bottom of the report. And here's where that explanatory paragraph is at. So it says, discuss in note 8 to the financial statements. The company changed its method of computing depreciation in 2016. Our opinion is not modified with respect to this matter. So we're okay with it. The client did have necessary footnote disclosure, so that's great. They comply with what they should. Well then, next thing in the chapter outline is B. Substantial doubt about the client's ability to continue as a going concern. So we think they may cease business. And the auditor must assess whether he or she believes the client can survive for a period of 1 year past the date of the financial statements. The auditor is not a predictor of the future, but we have to look for some signs of trouble. They're on page 56, just view them when you have a chance. Things such as lack of cash flow. So cash shortage, they can't pay their bills. And again, the auditor is going to modify the report by adding an explanatory paragraph after the opinion section. And the client must have footnote disclosure. Alternatively, the auditor may issue a disclaimer of opinion instead if they really are conservative and really want to play it safe. But that's very rare, just so it exists. And reading on, however, if a disclaimer is issued, the explanatory paragraph should appear before the opinion paragraph, since the latter is modified. So that follows the general rule. Explanatory paragraph before the opinion paragraph because the opinion section or opinion paragraph is modified. If the opinion section is not modified, then the explanatory paragraph comes after it. Then C, Rule 203 reports as we had earlier. So this is a justified departure from GAAP, such as for the cash basis, the income tax basis, or IFRS. Well, remember the auditor will modify the report by adding an explanatory paragraph after the opinion section. And that the explanatory paragraph is actually going to state the basic accounting, like describe the cash basis just a bit. The client must also have footnote disclosure. Then D, emphasis of any matter the auditor desires. The auditor can talk about anything. And the auditor is going to modify that report by adding an explanatory paragraph after the opinion section. But the client need not have footnote disclosure because this is something that originates from the auditor. The auditor should not use language in the opinion paragraph to refer to the explanatory paragraph because if the auditor does, it is thought that that is almost like qualifying the report. Readers could get confused, so we never do that. Emphasis of a matter is always optional. It's up to the auditor. The ASB suggests that the auditor emphasize such matters as large numbers of related party transactions and material uncertainties, like lawsuits we're not sure how they're going to be solved. So anything we wish to talk about, here it is. Then E, reports involving other auditors. Well, here another auditor audited a segment of the client, like a subsidiary. 3 possible reports to issue. And the first one is where we, as the principal auditor, the one who is auditing headquarters, is going to assume complete responsibility for the other auditor's work. That doesn't happen very often because another auditor does not wish to take responsibility when some other auditor is doing the work and we're not quite sure if they did everything properly. So let's assume that we do take complete responsibility. We'll issue number 1, the standard unqualified audit report, which makes no reference to the other auditor. That's applicable when the principal auditor, who issues the main audit report for the client, like we're doing with headquarters, is willing to take complete responsibility for the other auditor's work. Or if the other auditor audited an immaterial portion of the financial statements. So that second possibility is the more common by far. And the other auditor's report should not contain a material qualification. If it does, we will qualify our report as the main auditor. Then number 2, a standard unmodified audit report which has modified wording to refer to the other auditor. And that's called a modified wording report. There's an example on page 58, just glance at it. I just want you to know that there is no explanatory paragraph, but some of the paragraphs will simply refer to the other auditor. So this type of report is applicable when the principal auditor wishes to share responsibility with the other auditor. And the other auditor's report should not contain a material qualification. Again, if it does, we must qualify. So the shared responsibility report in number 2 is actually the most common. Now, number 3, third option, not so great from the client standpoint. That is when we qualify the opinion paragraph. And that's applicable if the principal auditor does not wish to assume any responsibility for the other auditor's work. So if we are not convinced about the other auditor's quality, we would go with this. And this is also applicable if there's material qualification in the other auditor's work. So we would qualify too. Now, Roman numeral 4 just has some other notes for a few things I want us to be aware of. First thing here in A is, what if we have more than one thing going on with the audit report? Well, I'll tell you the underlying thing we need to do is to make sure that we come clean. We're transparent. We bring everything out exhaustively. So with that in mind here in A, if there's more than one condition requiring a modification in the standard unqualified audit report, the auditor should exhaustively enumerate these conditions in the audit report. There should be one separate explanatory paragraph for each condition, and there should be a separate except for qualification for each condition which requires a qualification. One caveat, however, if the auditor is not independent, should only issue the report that we saw on page 65. That's the one for lack of independence, that very, very short one in which we can say nothing else. It doesn't even have a report title. Then B, later in the course, as we discuss interim reviews for public companies where we can do a lesser form of engagement than an audit and review a client's interim financial statements like quarterly financial statements, we can give negative or limited assurance on them. Negative and limited assurance, same thing. Anyway, this negative assurance is not permissible in an audit report on annual financial statements. Negative assurance says that nothing came to our attention to show that the financial statements were not fairly stated in accordance with GAAP in all material respects. So it just means we happen to find nothing. It's not very far-reaching. But an audit provides positive assurance instead. We give an audit opinion. In our opinion, we believe the client's financial statements are fairly stated in accordance with GAAP. So positive assurance is, shall we say, much more useful, much more valuable then negative assurance. Then C, a piecemeal opinion is not applicable. Piecemeal opinion gives different opinions on the different financial statements. They used to be around decades ago, but they're not anymore. Instead, the auditor gives one opinion on the financial statements taken as a whole. We know that from generally accepted auditing standards. D, just a little reminder about the Edgar database, Form 10K for the annual financials. Then E, under Section 404 of the Sarbanes-Oxley Act, management must issue a report which attests that they're responsible for internal control, as well as their assessment of the effectiveness of internal control. This was required by the Sarbanes-Oxley Act, so this way the responsibility is pinned down to management. Sarbanes-Oxley Act was in response to the Enron fraud, and Enron's management was not nearly this responsible, shall we say. Nowadays, the management team must be very, very responsible. Penalties are big, but they're not. Well, then, the auditor also issues a type of 404 report. So the auditor must attest to management's internal control report. And this means the auditor is going to integrate the audit of the financial statements with an audit of internal control for SEC companies, SEC or publicly traded companies. And the auditor may issue this report about internal control separately from the financial statement audit report, or they could be combined. Read over it when you have a chance, because we'll study more about 404 reports in Chapter 10. I won't test you on them for now. Certainly, after 404 reports were phased in after the Sarbanes-Oxley Act, the cost of audits went way up for SEC companies. Then F. With audit reports, they go along with annual financials, and a lot of companies like to showcase those annual financials in an annual report, which contains lots of other information. And the annual report could be online, on a website, or many companies still produce paper ones, because there's some prestige to being able to mail these to important stockholders, etc. Here's what auditors must do. They must read the other information contained in the company's annual report to make sure it's consistent with financial statements. However, auditors are not required to read information contained in websites, even though the financial statements may be posted there. This because website information is not considered to be documents under GAS, and the loophole may be addressed in future authoritative guidance. So, what is said on the website could get by, even if it's not consistent with financial statements, but any information in a paper annual report, which contains write-ups by management along with financial statements, well, those write-ups by management being other information, they have to jibe with financial statements. And the auditor is going to make sure of that. A careful auditor will even review information on the company's website. Because an auditor never wants a set of financial statements going out, and then there's other information about that company floating around someplace out there that is not consistent with the financials. For example, here at Florida Southern, with the Weinstein Computer Science Center building, well, as that was under construction. Yes, it was mentioned in the Florida Southern College annual report. The auditor had to make sure that, yes, indeed, it's being built. The auditors, in fact, went out and saw it, just made sure it was there in a form of construction. So good, it's mentioned in the financial statements. Now we've seen it there in action, and we also, of course, see that there's some connection here. And that's what the auditor is after. If there is any information in a company's annual report outside basic financials that's not consistent with the financial statements, we ask the client to correct it. If they don't, there's a special type disclaimer of opinion, which we can actually offer. And no client wants that. Obviously, the thought there is that If a client will not correct this other information, that means they probably have something undesirable going on. Also, I should say that other information is outside the basic financial statements, so therefore we're not talking about footnote disclosure in the financials or parenthetical disclosure in the financials. Footnote and parenthetical disclosure, well, that's required by GAAP, part of the financial statements. Now, finally here in the chapter, some little hints here on homework questions in Chapter 3. So much of the homework deals with audit reports which require explanatory paragraph. Prior to doing homework, it would be helpful to remember where the explanatory paragraph appears in the audit report. We covered the placement in the regular chapter outline, and we saw the explanatory paragraph appears one of two places. First, before the opinion paragraph, if it changes the opinion section in any manner. So this way, the reader is read through that explanatory paragraph. The reader then gets down to the opinion, and the reader knows why that opinion has been changed. Second possibility is to place the explanatory paragraph after the opinion section if it does not change the opinion in any manner. So therefore, the reader did not need to read through the explanatory paragraph before reading the opinion. So that's the general rule of thumb. As you know, on the CPA exam, they often have a simulation question with paragraphs in random order. You must drag and drop them into the correct order. So let's see specifically which things appear before the explanatory paragraph and after it. So here's the breakdown of the types of explanatory paragraphs we've seen along with proper placement. And we remember any of these conditions must be material before the explanatory paragraph is added. If immaterial, we don't worry about them, quite frankly. We skip over immaterial items because it's not worth trying to investigate them and hold up the audit and incur more audit expense. So, two types of explanatory paragraphs before the opinion section. One will be unjustified departure from GAAP. So financial statements which are not in accordance with GAAP, some misstatement will be in the financials normally because of that. Then the second is the scope limitation. Then we have the opinion paragraph and explanatory paragraphs after the opinion section. We just saw these four. Change of accounting principle, so either GAAP to GAAP or non-GAAP to GAAP. Definitely not GAAP to non-GAAP. If GAAP to non-GAAP, we would bump up here to the unjustified departure from GAAP again. Then going concern issues, we think the client may go under unless the auditor chooses to issue a disclaimer, and that's very rare. Then justified departure from GAAP, it's a Rule 203 report, such as a client who is on the cash basis or income tax basis or IFRS basis. So again, more about those in Chapter 25. We won't worry further about them for now. Then finally, emphasis of any matter the auditor desires. Then we'll remember that we will have special reports for lack of auditor independence. That short paragraph is the only thing that we can say. There's not even a report title, as we know. And also special reports for, or I should say just reports involving other auditors when responsibility is shared. So in that, we refer to the other auditor throughout the audit report, and we do not have an explanatory paragraph in that case. That concludes Chapter 3. Thank you for listening, and please let me know if you have any questions.